Ladies and gentlemen, good day and welcome to Q3 FY’25 earnings conference call of Renaissance Global Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Sneh Kumar Purohit from Renaissance Global Limited. Thank you, and over to you, sir.
Thank you, Yusuf. Good afternoon, everyone, and thank you for joining us on Renaissance Global's Q3 and 9-month FY’25 earnings conference call. We have with us today Mr. Sumit Shah, Chairman and Global CEO, and Mr. Darshil Shah, Managing Director of the company. We would like to begin the call with brief opening remarks from the management, following which we will have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and the disclaimer to this effect has been included in the results presentation shared with you earlier. Shah, to make his opening remarks.
Good afternoon, everyone. On behalf of Renaissance Global, I extend a warm welcome and thank you all for joining us on our earnings conference call for the third quarter ended December 31st, 2024. We are pleased to report a strong quarterly financial performance in Q3 FY’25, driven by robust growth in our key business segments. Total income from continuing operations grew by 18% year-over-year to 710 crore compared to 600 crore in Q3 FY’24. Our customer brand segment witnessed an impressive 34.2% year-over-year increase. Our adjusted EBITDA grew by 32.8% year-over-year, driven by robust cost management and optimized product mix, reflecting our focus on profitability and margin expansion. To further enhance operational efficiency, we initiated a cost optimization program towards the end of Q2 and extending into Q3. This initiative is expected to deliver annual savings of 40 to 50 crores. The benefits of this program are already evident, with employee and other fixed expenses showing a sequential decline. Additionally, we incurred a one-time restructuring expense of 15 crores in this quarter. As a result, on the profitability front, our adjusted profit before tax rose 45% to 47 crore compared to 32 crores in Q3 FY’24. And adjusted PAT stood at 35.6 crores, up 28% year-over-year, with margins improving year-over-year. Our financial position remains strong. Our net debt to equity improved significantly to 0.14 as of 30th December 2024 compared to 0.27 on September 2024. Total net debt declined to 188 crores, down from 328 crores in Q2 and 311 crores in December 23, highlighting our commitment to financial discipline and deleveraging. We anticipate further debt reduction by March 31st, 2025. Meanwhile, our cash, bank balances and current investments remain robust at 395 crores, reflecting an increase of 151 crores since September 30th, 2024. Inventory levels have also improved, standing at 972 crores, down 173 crores from Q2 FY’25. As part of our broader vision to expand in the ultra-luxury fine jewelry lab-grown segment, we made a strategic investment in Jean Dussett LLC, founded by Jean Dussett, the great-great-grandson of Louis Cartier. Jean Dussett is recognized worldwide for his craftsmanship, innovative design, philosophy, and modern interpretation of high-end luxury jewelry. His ability to merge heritage with contemporary sophistication makes this jewelry design a natural fit for our expansion strategy. Jean Doucet operates through his flagship store in West Hollywood, complemented by a strong online presence. As part of our expansion strategy, we plan to open 3 additional Jean Doucet stores in FY'26. The current store contributes 25 crore to top line, and we have similar expectations from the new stores. As part of our India-owned segment initiative under IRASPA, we have successfully introduced with clarity to the Indian market, offering customizable lab-grown jewelry through a strategic shop-in-shop model within IRASPA and a dedicated D2C website. With our current cost optimization program, we plan for our India division to break even in FY'26 and plan to accelerate growth in this high potential segment. And we plan to expand our retail footprint in FY'26, reinforcing our commitment to driving lab-grown market in India. Due to our continued investments in our brand's D2C segment, we expect this segment to be greater than 300 crores in FY'26, a growth of more than 50% from the current year. This segment, as a reminder, in FY'22 was 30 crores. We've grown this segment 10x over a 4-year period. Moving on to our licensed brand segment, Enchanted Star, a lab-grown diamond extension of our Disney fine jewelry brand, has been met with a very positive consumer response in the US market. Following a successful test, we now plan to go ahead with a full-scale rollout in partnership with a leading US retailer. During this quarter, we successfully raised 163 crores through a preferential allotment, further strengthening our balance sheet and financial flexibility. This ensures that we are well positioned to pursue strategic opportunities and accelerate growth across global markets. I would also like to express our deepest gratitude to Mr. Hitesh Shah, who has been a guiding force in Renaissance's journey. While he retired as Managing Director on December 31st, 2024, we are honored to have him continue as Non-Executive Director and Management Consultant. His wisdom and leadership will remain invaluable as we step into this new phase of our growth. And with great excitement, we welcome Mr. Darshil Shah as our new Managing Director, a chartered accountant with a strong foundation in corporate law and finance. Darshil has been a driving force behind RGL's strategic expansion and operational excellence. Having effectively overseen our Middle East business corporate strategy team and having served as Executive Director for the past 2 years, he is positioned to guide RGL into its next chapter of innovation and growth. Our focus on expanding the branded lab-grown jewelry division and strengthening operational efficiencies positions us well for long-term sustainable growth. With iconic partnerships, cutting-edge craftsmanship, and a commitment to innovation, we are confident in our ability to meet customer expectations and deliver value to stakeholders. With that, I now hand over the call to Darshil, who will provide a detailed breakdown of our financial performance.
Thank you, Sumit. Good day, everyone. We have reported a steady performance during the quarter, driven by robust growth in the customer brand segment. In Q3 of FY'25, our adjusted total income grew by 18.3% and stood at 710 crores versus 600 crores in the same quarter last year. On the profitability front, adjusted EBITDA for 9 months FY'25 expanded by 32% year-on-year, reaching 147 crores compared to 111 crores during the same period last year. Adjusted EBITDA margin saw an improvement to 10%, up from 7.1% for the 9-month period FY'24, reflecting enhanced operational efficiencies and disciplined cost management. Our margins improved during the quarter, and we anticipate a continued upward revenue trajectory in the upcoming quarters. Adjusted PAT for Q3 FY'25 stood at 35.6 crores, marking a 28% year-on-year growth. compared to 28 crores in Q3 FY'24, with margins expanding from 5% to 5% from 4.2%. For 9 months FY'25, adjusted PAT increased to 66.8 crores, up from 52.6 crores during the same period last year, with margins improving to 4.3% from 3.3%. In our owned brands segment, revenue for 9 months FY'25 reached 158 crores, up 12.3% year-on-year, compared to 141 crores in the same period last year. Within this segment, our US owned brands recorded 141 crores of revenue, delivering a 13% year-on-year growth, highlighting our continued success in this market. The licensed brands business maintained stable revenue at 308.6 crores for 9 months FY'25, supported by a steady flow of orders from our retail partners and the D2C channel. It reported an EBITDA margin of 14.8%. Meanwhile, our customer brands division reported a revenue of 1,007 crores for 9 months FY'25, with an EBITDA of 86 crores during the period, showing an EBITDA margin of 8.5%. Lastly, regarding our balance sheet, we remain focused on strengthening our financial position. The proceeds from the preferential allotment have helped improve our net debt to equity ratio, which improved to 0.14 as at the end of December 24, compared to 0.27 at the end of September 24 and 0.28 at the end of December 23. Total net debt stands at 188 crores, down from 328 crores at the end of Q2 FY'25 and 311 crores at the end of December 23, demonstrating our focus on financial discipline. Furthermore, we anticipate a further reduction in gross debt by 31st of March 25. Meanwhile, our cash, bank balances and current investments remain strong at 395 crores, marking an increase of 151 crores from September 30th, 2024. In conclusion, we are pleased with our resilient performance amid evolving market dynamics. Our strong balance sheet, operational excellence, and strategic initiatives position us well for sustained growth. We remain confident in our ability to navigate challenges and capitalize on emerging opportunities, and we look forward to delivering even stronger results in the coming fiscal year. With that, I now request the moderator to open the forum for any questions or suggestions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we'll wait for a moment while the question queue assembles. First question is from the line of Ritesh Gandhi from Discovery Capital. Please go ahead.
Hi, sir. And kind of congratulations on your numbers. Just had a few questions. We've seen a robust growth on our customer clients products, and our own D2C has been reasonably slow at under 5%. Just wanted to understand the reason for the high growth in the customers and the reason for the low growth in our D2C business.
Yeah, thanks for the question. So, our customer brand segment has been sort of under pressure for a couple of years, and as we made our transition to lab grown, we are seeing sort of re-emergence in growth in that segment. So, I think that the 34% growth that we see in the customer brand segment is on the back of 2 years of decline back to a normalizing situation. On our own brands, I think our primary focus has been to improve profitability and really control our marketing spends in order to get the business to a profitable level. We see opportunities to accelerate the our brand segment in the next year, especially given the recent strategic acquisition that we've done. So I think our brand segment I think that has grown significantly. We were at about 30 crores in FY'22, and we'll be at 200 crores this year, expecting to be at 300 next year. So I think in this phase of rapid growth, I think the focus was really on customer acquisition and brand recognition. I think that for this year we focus a little bit on profitability, and we do see growth reaccelerating next year in our brand segment.
So if you're just saying we'll do about 200 crores next year and 200 this year and 300 next year, you're saying we could have a 50% growth in our own brands, and that too with potentially higher profitability, given our focus is now on the profitability as well.
Yeah. I think that's our outlook for next year would be more than 300 crores in our brands, especially given that there is a new brand that we've made a strategic investment in, and along with
is that organic or inorganic?
So the 300 crore number would be a combination of both organic and inorganic. It will be greater than 300 crores would be the total.
Organic would be how much in your view in terms of the growth?
So, I would say that, safe to say between 15 and 20% organic growth, and the remainder would be through the strategic acquisition.
Got it. The other question is, after the exit of your gold business and the preferential allotment, etc., while we have seen your effectively net debt go down, your gross debt remains the same, and obviously our interest rate isn't exactly is also reasonably high. Any reason why we have so many cash and the cash equivalents, and how much is your split between your cash and cash equivalents and your actually current investments?
Yeah. So the money from the preferential allotment came in actually in the last week of December. So we hadn't yet paid down the debt as of 30th December. Obviously, the plan is to pay down the gross debt, and you'll see the gross debt number being significantly lower in the current quarter. I think that it's a timing issue in terms of when the money came in and when we got permission from the concerned authorities to utilize the money.
Got it. So all of the QIP proceeds will initially be used to pay down the debt, especially the higher cost debt. That's
right.
And I mean, how much is the breakup between your cash and equivalents and your investments, and have your investments gone up at all, or they remain the same?
No, the investments are at about 100 crores. Everything else is they've remained steady at 100 crores for the last 4 or 5 years. We've not increased them. In fact, when the value of the investment goes up, we usually sell it down. So it usually fluctuates between 100 and 120 crores, and the rest is in cash. So
right now, given
that Mr. Gandhi, may we please request you
I'll come back to
the question.
Okay.
Thank you, sir. Next question is from the line of Hemang Dagli from Centrum Broking. Please go ahead.
Hello. Good afternoon, sir. Thank you for the opportunity. I wanted to understand what is the lab-grown diamond as a percentage of our total sales, that is 1,566 crore for the 9 months.
Yeah, I wouldn't have that number off the top of my head right now, but we can get back to you. I think that if I were to guess roughly, it would be in the 30% range or so of our total revenue, but I can have my IR team come back to you with the exact number.
Okay. And we are looking at a growth of around what growth are we looking for FY'26 in this particular segment?
In which segment, sir?
If lab-grown put as a overall revenue number.
So, we don't track, sort of growth in lab grown, because the way we manage our business would be as, our brands, licensed brands, and customer brands. So, if I were to tell you in our brands, we would be looking at an absolute growth of about 50%, and our brands are primarily lab grown. So, this 200 crores in revenue going to greater than 300 crores would be all lab grown. I think within the licensed brand segment also, I think we would expect to see more than a 50% jump in the lab grown business. And, we're seeing a very strong migration even in the customer brand segment to lab grown. So, I think that the share of lab grown would increase meaningfully. Difficult to come up with an exact number, but, safe to say that the percentage of lab grown, would be north of 50% for FY'26.
Great. So, on the margin profile for lab-grown diamond compared to the real diamonds, could you throw some light over there? Just for our understanding that how the margins will improve with lab-grown as a percentage going up for our overall revenue.
Yeah, so I mean, margins on lab grown are definitely better, and should help margins going forward. I think the other advantage for our tailwind to our margins is actually we've invested significantly in sort of growing our direct to consumer business, which has been margin dilutive for 2 or 3 years as we've grown that business from 30 crores to 200 crores. And now that we've reached some critical mass, we expect normalization of margins in that segment, which should help margins as well. And in the other 2 segments, increased penetration of lab-grown diamonds will definitely help margins.
Okay, that was helpful. Thank you.
Thank you.
Thank you. Next question is from the line of Shrikant Parekh from Prudent Investments. Please proceed.
First of all, congratulations on a good set of numbers. And my question was particularly line of debt, continuing from the last participant's question. Where do we see our company going to be debt free?
Sorry to interrupt, Mr. Parekh, your voice is breaking.
Okay. Am I audible now?
Yes, please go ahead.
My question was again on the lines of debt, actually. Is there any plan of us going debt free in near future in like FY'26 or 27?
Yeah, so I think, currently, our net debt is at about 188 crores, and our expectation is that this number will be lower on 31st March this year. Clearly we've made a commitment to reducing our debt, and we expect to definitely be sub 100 crores in the following year. I think that with 1,300 or 1,400 crores of equity, I think a net debt of sub 100 crores is not a meaningful number, and our endeavor would definitely be to be at zero or near zero net debt in the next 18 months or so, 18 to 24 months.
Okay. And secondly, regarding the acquisition which we recently did, what will be the contribution of it towards our top line or bottom line? Any additional, because I don't think we have got contribution from those acquisition in Q3. So what kind of the contribution which we can look in Q4 and onwards?
Yeah, so the acquisition that we have done will add around 80 crores or so to the top line for the next financial year. I think that currently the company broke even last year or actually had a slight loss. So we are working at cost reduction measures in the company and consolidate operations under our D2C segment. So we expect to deliver profitability. Hard to say where we land, but the company was at a small loss last year, and it will add about 80 odd crores to the top line.
Okay. And on a consolidated basis, I don't want the segment-wise the numbers, but on a consolidated basis, what would be kind of a guidance you would be looking into revenue and the margin spaces for the next year, financial year?
Yeah. So I think that, currently, what I can tell you qualitatively is that the demand environment is finally very strong. I think that, our largest segment, the customer brand segment, was muted for a couple of years, due to our transition to lab-grown, consumer inflation and various factors. We are seeing a lot of that largely behind us. We expect to have reasonably strong growth and especially strong improvement in margins because of our cost reduction initiatives that we've undertaken in Q3. So, we should have strong revenue growth with even stronger growth in profitability, given the business shift, our brands finally reaching a critical mass, as well as a cost reduction program.
Is there by any chance
Sorry to
you
interrupt,
could see
Mr.
some
Srikanth.
double-digit?
Please request you to rejoin the queue, sir, for the follow-up questions.
Yes, sure.
Thank
Sure,
you.
sure. One second. Sure.
Thank you. Before we move to the next question, a reminder to the participants to ask a question. You may press star and one. Next follow-up question is from the line of Ritesh Gandhi from Discovery Capital. Please proceed.
Hi. So I just want to also understand in terms of the restructuring, are there going to be any implications in Q4, or all of the restructuring expenses have been taken into Q3?
It's all been done. All of the restructuring expenses have been taken already.
And how much of a kind of cost savings are we expecting out of this?
So I think on an annualized basis, we're expecting 40 to 50 crores of cost savings on an annualized basis.
So all this would flow straight to the PBT, and this too starting from Q4, is it?
Yes, it should.
Got it. So, and the last question again, just going on your cash and investments. Right now, we've not put in any of the pref capital or any of that into investments, right? It's being ultimately used to pay down debt and like a gold and like gold.
All of the, as I mentioned earlier, all of this, the fundraise from the preferential allotment will be used to pay down debt, and obviously for some capex going forward as we plan to open a few more stores for our India retail business as well as for Jean Doucet, but they will not be used to add to investments.
Got it. And just actually on our own brands, it was a little deliberate that we sort of slowed it down, or it was an implication of our kind of optimizing our marketing spend. And then you just wanted to know, what is giving us the confidence of going to a 15 to 20% organic growth in our own brands business?
Yeah, so I think that it's been a deliberate strategy for us to kind of focus this year on improving our profitability because given the company size, I mean, we felt that as a company we needed to focus on profitability more. So I think all of the business heads and all the business divisions this year have really put their heads down to optimize costs, optimize marketing spends, and make sure that we deliver profitability before we reaccelerate growth. So I think that the markets in which we operate are large markets, and we're still very small players in the markets that we operate in. So we don't see a challenge in reaccelerating growth. I think that we want to ensure that we get to especially on the own brands to 15% kind of operating margins while we accelerate growth. So we've kind of bridged that. I mean, we're made significant improvements over the last couple of years from our own brands being loss-making to now being profitable. So I think we're fairly confident that, given the size of the addressable market being quite large, we should be able to, grow the business 15 to 20% organically.
US. I'm assuming the exchange rate depreciation should also help us?
Sorry, I actually didn't hear your question. Can you repeat that?
No, I was asking, is the exchange rate depreciation going to be helpful, given both our customer and owned brands are primarily in the US market? Is the rupee depreciation helpful to us, and are we hedged, and if so, for how long, and then when do we see the positive implications come through?
Yeah. So, I think that for us, a lot of our raw material costs are also in US dollars. So any benefit from the rupee depreciation really is on our operating costs, not really from a raw material perspective. So, I would not say that there would be a meaningful improvement in profitability due to the rupee. Obviously that, 2-3% extra growth due to the rupee depreciation, you're likely to see.
Got it. Understood, sir. All the best. Thank you.
Thank you.
Thank you. Next question is from the line of Smitesh Seth from Redan Capital. Please go ahead.
Good evening, sir. Sir, could you throw some qualitative details with in H1, how do you intend to grow? What are the number of stores we plan to open? How do we intend to scale up those things? Some qualitative details with actionable points would be appreciated, sir. Thank you.
Smitesh, could you repeat your question? I lost you there for half of your question.
Yeah. So could you please throw some qualitative details with regard to the growth in India for our own brands online with Clarity as well as the Erasma and stuff? And how do we plan to scale both of them online with Clarity and the physical stores also? Like number of the stores we intend to open in H1, in H2 with actionable things. So qualitative plus pointers would be appreciated, sir.
Yeah. So I think on the India retail side, we are very encouraged with the momentum that we are seeing currently on the India retail side, and while we did our entire cost rationalization program, we've done the same for our India retail business as well, because as you can see, that business was or is in Q3 losing a significant amount of money. We expect that in FY'26 the business should break even, and even in Q4 the numbers will be a lot better than what they were in Q3. With that in mind, we currently have a plan to open 5 stores in FY'26 in the next year. I don't have a plan in terms of H1 and H2 yet, because all the store locations have not been finalized. But I think the unit economics are looking quite favorable, and we definitely expect to ramp up the India retail business in the coming years. So I think currently the plan is for 5 more stores in FY'26.
Okay. Thanks a lot, sir. And sir, some thoughts with regard to the scaling up of with Clarity also. I mean, number of the visitors and repeat customers and some data points as well as scalability.
Yeah. So on sort of our US brands, I think we've focused this year on profitability, and growth is at about 13% or so. I think as I mentioned before, I think we expect that growth to be in that 15 to 20% range for our US brands organically, and then obviously the inorganic growth would take it to north of 50% for next year.
Okay. Thank you, sir. Thank you.
Thank you. Next question is from the line of Pawan from Geojit PMS. Please go ahead.
Yeah. Hi, sir. Sir, just a couple of questions. One, just want to understand how is your license brand business different from your customer brand business?
Yeah. So the licensed brand business is essentially a business where we are licensees for the Walt Disney Company, for Hallmark, NFL, and Warner Media. We use the licenses of these iconic global brands. We pay them a royalty, and then we distribute the product through retail partners as well as direct to consumer. And the customer brands business is essentially a business where we design, manufacture, and sell jewelry under the customer's brands. So this is essentially a private label business where we do not license or own the brands. So the way we've segmented our business is, number one, our brands, number two is licensed brands, and number three is private label, essentially. The customer brands is a private label segment where the product is sold to brands as well as to large retailers under their brand name.
Okay. So essentially, sir, in the licensed brand, since we are also capturing kind of some sort of retail margins also, apart from the manufacturing and designing one, shouldn't the margins be a lot more higher, or is it maybe, as the business scales up, these margins can then potentially improve substantially going ahead in, say, next 2-3 years?
Yeah, so our licensed brand segment, is currently for the 9 months at about 15% operating margins. We feel that, this will remain in this 14 to 17% range because, 75% of this business is distributed through retail partners. The margin is higher on the direct to consumer side, but I think as an average between the two segments, I think 14 to 16% is a fair operating margin for the licensed brand segment, and we don't see too much upside in that segment. The opportunity for margin improvement is really in the other two segments. In the customer brand segment, where we've undertaken a cost reduction initiative, and our brands, which have been loss-making previously, and we've optimized the cost structure there, and we plan to see improvement in margins in our brands.
Okay, and so essentially we have got multiple brand websites. Those e-com business that we do, is it profitable in its own, standalone basis?
Yes. Currently in the licensed brand segment, the e-com business that we run makes 18 to 19% operating margin, and in the US it's about 11% margin for the year. On the India retail business is what has been a drag. It's a minus 16% operating margin. Next year, I think we plan to see improvement in the India business because we've reduced costs meaningfully there. So to answer your question, the e-commerce businesses are profitable, both licensed brands as well as our brands.
Right. And in both
Sorry to interrupt, Mr. Pawan. May we please request you to rejoin the queue for the follow-up question, sir? Thank you.
Sure.
Participants, to ask a question, you may press star and 1. Next follow-up question is from the line of Shrikant Parekh from Prudent Investments. Please go ahead.
Thank you once again. Sir, my question was, I had just two questions. One question is on what is the currently our the debt level on which the interest is serviceable?
Sorry, are you asking what is the gross debt on which we are paying interest?
Yes.
Yeah, so I think the gross debt is somewhere around 500 crores, on which we're paying around 8 or 8.5% interest. And that number will obviously go down during the quarter by around 150 crores or so as we pay down the proceeds from the preferential allotment on the short-term borrowings.
Okay. And sir, one thing I wanted to understand about the lab-grown diamond business, the spread between the real diamonds and the lab-grown diamonds, that poses a risk for our lab-grown diamond business?
I think they're different products. I'm not sure if I fully understand your question, but I think lab-grown diamonds are meaningfully cheaper than natural diamonds, and I think that consumers understand that there are different products, and I think that there is consumers who choose one over the other. I mean, having said that, the lab-grown business is growing meaningfully, and the natural diamond business is either stagnant or shrinking. So consumers have clearly, in the US, demonstrated a preference towards lab-grown diamonds, and demand is migrating towards lab-grown diamonds.
Oh, thank you, sir.
Thank you. Next question is from the line of Ritesh Gandhi from Discovery Capital. Please go ahead.
Hi. So just to clarify, so effectively, if we are looking at about, let's say, 45-50 crores of like cost savings, which we've implemented, and then another 150 crores of debt pay down at, let's say roughly 9% odd, we are talking about roughly about a 25 to 30 crores a quarter of incremental, actually PBT just on these two effectively.
No, if we pay down 150 crores of debt, that's 12 crores a year. That's 3 crores a quarter.
Sorry, 3 crores a quarter there and about 12 crores, so about 15 crores.
Yeah, 15 crores additionally, and 40 to 50 crores is a cost saving. That's right. Your number is correct.
Got it. Understood. That's all for me. Thanks.
Thank you. Participants, if you wish to ask a question, you may press star and 1. As there are no further questions from the participants, I would now like to hand the conference over to Mr. Sumit Shah for the closing comments.
Thank you everyone for joining us on today's conference call. We look forward to seeing you to discuss full year financial results. Thank you.
Thank you. On behalf of Renaissance Global Limited, that concludes this conference. Thank you all for joining us, and you may now disconnect your lines.